This is Capital Ideas TV. Coming up on the show, the CEO of Siyata Mobile on its next generation push-to-talk technology. Fabrice Taylor on why investors should be aware of warrants. Dan Lloyd is bullish on goeasy. And the CEO of Solar Reliance on growth plans and William Shatner. Hello and welcome to Capital Ideas TV. I'm Mark Bunting. Do you remember the company Mike and its push-to-talk technology? Well, Siyata Mobile is multiple generations ahead of that with the difference. They don't focus on the consumer, they focus on business. Companies that operate fleets, like truckers, for example. Siyata Mobile is growing fast, and it says it has first mover advantage in what could be a $40 billion market. Here's our conversation with the CEO of Siyata Mobile. So Mark, in Canada, if somebody hears push-to-talk, they think, oh yeah, wasn't that Mike years ago? And so tell us about that. This is sort of the next generation push-to-talk, but it's a lot different too. So explain exactly what kind of technology you have at Siyata.
So thank you for having me. Push-to-talk technology has been around for about 50 years. It's called land mobile radio. That technology allows you to speak one person, like a dispatch, to many people. Sort of like WhatsApp, when you create a group, you speak one person to many people. Mike Network was around for many years. They were pretty successful. They were actually owned by TELUS. And it was a device that was used mainly for blue-collar workers and for industrial type of situations, whether it's oil and gas, trucking companies, logistics companies, and whatnot. Now the cellular operators want to get into what is called push-to-talk over cellular, which basically does the exact same thing, allows you to speak one person, a dispatch, to many people, and allowing you to speak back to the dispatch. But it's all over the cellular network. So as opposed to doing it over a mic network, or as opposed to doing it over a land mobile radio network, now you can do it over a cellular network. And all of the major North American operators are very focused on getting into this very fast-growing business because it's a very, very effective way for speaking to your employees in a blue-collar environment.
And that's where you guys come in and you think you have first mover advantage. You've actually got a mock-up of your new device.
Correct. So there are over 12 million commercial vehicles in North America. It's a very large-scale market. Just to give you an idea, Bell has a few 100,000 commercial vehicles on their network. A commercial vehicle is a bus, a truck, an ambulance, not a consumer car, not a Ford or a BMW, but a commercial vehicle. Just to give you an idea, there's over 10 million commercial vehicles in the United States. So it's a very large-scale market. We don't see anybody addressing this market, working with cellular operators to offer devices that support push-to-talk over cellular with cellular capabilities. So we do have this device here. We announced it about 2 months ago. We expect to have it commercially launched in about 2 months from now. And we think that this is going to be a very attractive device for operators to sell to their enterprise customers.
And what's special about this? What are the features?
It's Android-based, so you can basically put any kind of application on it. You can have any kind of fleet management application or time log application on it. It has push-to-talk over cellular capabilities. So the same way that you would use a land mobile radio, you would use a device like this, which is connected into our device, and you just push the device and then you speak to your dispatch. So basically for the driver, it's seamless. You don't have to do anything different than what you've been doing until now. But besides that, it also has cellular capabilities. So you can actually make a phone call from it. So whereas a two-way radio system, which could cost $2,000 to $3,000, can only do dispatch and do two-way radio, this device can do applications, cellular calls, push-to-talk over cellular. We believe that this is literally the next generation of two-way radio systems, and we think that it's very unique because there is nothing like this in the market.
So when we survey the competitive landscape, especially in the U.S., you don't see any other company doing this?
As far as we know, there's no other companies doing anything like this. We've sold over 250,000 devices specifically with voice only, not data devices, but voice only devices for commercial vehicles. And this is sort of the next generation of our products. We know how to work in loud environments, how to do very good echo cancellation, how to connect to commercial truck batteries, how to have an external antenna. So we know how to put all the ingredients to have a very good user experience in a commercial vehicle environment, which is not similar to a private car, okay? It's much louder, you're driving much longer distances. It has to be able to work in extreme heat or extreme cold. So this is a dedicated device for a very specific market, and as I said, it's a very large-scale market with over 12 million commercial vehicles just in North America.
So dollar-wise, how big is the market? What's the potential here?
The potential is north of $8 billion. That's the overall market for this product. Again, just in North America. That doesn't include other opportunities that we're looking at in Europe and in other areas. And we're going after this market. We think that we have first mover advantage. We expect to launch with a few North American carriers within the next 6 to 9 months. So we think that we have the first mover advantage and that we'll be able to capture a very large part of that market in the years to come.
Who are some of your current clients?
We're working already now with TELUS and with Bell, with all the cellular operators in Israel, with the largest cellular operator in the UK, an operator called EE, with operators in Australia and in Sweden. And we expect to be able to launch with an American carrier, as I said, in the next 6 to 9 months.
Let's talk about some of the fundamentals with the company. What sort of growth are you looking at, revenue, EBITDA, and so on?
So we've been able to grow the company double-digit growth over the past 3 or 4 years. This year we're already at around 50% growth quarter over quarter, and we expect that to continue growing. Last year we did a little over $12 million. We're forecasting this year to do around $20 million or more. We believe that we'll be able to continue that kind of 50% growth year over year over the next couple of years. We're already EBITDA positive, so we're not losing any money. We have no debt. We have about $8 million in working capital. We just continue to grow the company. We think that as the years go on, we'll have very strong EBITDA margins simply because we don't have to grow the expenses in the company, and we're certainly going after very large-scale markets. So we think that we'll be a very profitable company going forward.
Now, you founded this company. You're from Israel. You're traveling a lot. You're in Canada and the U.S. And around the world quite a lot. What are the challenges that you have found? What are the obstacles that, because every entrepreneur runs into something. What kind of challenges and risks have you come up against?
100%. You know, as a small company, there's always challenges. Getting into these large-scale opportunities, working with large-scale operators is always challenging. You know, we're a small company. We're a TSXV company. But because we already have very good traction at multiple operators and references in RCMPs, in rail companies, in ambulances, in various oil and gas companies. So we already have very good reference customers that we work with, and then we show them to the cellular operators who then understand that we have very good products. So initially getting into these operators is very difficult, but once you've cracked that market and you're able to get into these cellular operators, we think that the opportunities are very large scale.
So then you've got something tangible that you can show people and show investors as well. It's not just some mine in the middle of nowhere and you say, well, it's going to be great, but you actually have something tangible.
It's tangible, but even more than that, you can see from our numbers that the company has grown dramatically, and that we're growing this year, north of 50% quarter over quarter compared to 2016. So I think that the numbers speak for themselves, and I think that we'll be able to continue that growth going forward.
You sort of touched on a few of the aspects of the investment case already, but for shareholders, for potential shareholders, what do you say to them to say that this is a very compelling story?
I think that we are still a very early stage company. And I think that even though we expect to do around $20 million in sales this year, I think that we're still almost a startup company, simply because we're going after much, much larger scale markets with much more innovative devices. They're all 4G, they're all Qualcomm based with the latest chipsets. So we think that we'll be able to get into much larger scale markets with much more innovative devices. And therefore I think that that's going to grow our sales dramatically in the years to come. So I think that really we're still a very early stage company right now.
We're going to keep the conversation going now on Siyata Mobile. Joining us is Capital Ideas TV contributor Fabrice Taylor, who's been around the capital markets for a long time, involved in a lot of financings, and a lot of these financings have warrants attached. And it's sort of an area of the market that a lot of investors may not know about. So you want to give us a little 101 on warrants as they relate to Siyata Mobile.
Sure. Well, let's start with warrants in general. They're typically a way to entice people to take on financing. So when you write a check into a financing, that is, you're buying stock from the company's treasury, you'll typically get in a small company a unit. And the unit will include one share and usually a half a warrant, but sometimes a full warrant. A full warrant gives you the right to buy another share for a period of time that's limited and at a higher price than you're paying for the unit. They are useful in getting investors to write those checks. It's very difficult for small companies to finance without offering warrants. Bigger ones don't do it. But nonetheless, it's something that you should be very aware of as an investor, even if you're not taking place in that financing, which is typically restricted to accredited investors. When you look at a company, you want to do due diligence on the business itself. Does it make sense? Are they filling a need? Are these good people? Are they capable? Are they honest? That's pretty straightforward. But you should also always do due diligence on the capital structure of the company. That is, how many shares are outstanding, and then at what price did they finance, and where are those warrants? So in this case of Siyata, they've done a number of financings recently, and all of them have come with warrants. Right now, I think this is a stock that's probably going to do quite well. It's probably going to become one of these darlings. It's not well heard of yet, not well known, but you can buy this thing for cheaper if you're smart. And what you want to do is look at the financial statements and figure out when is their stock coming out into the market. Financings will have a 4-month hold on them. So you know if they finance as they did at 40 cents, and that stock is held for 4 months, well, when that 4-month period is up, if that stock is higher than 40 cents, people will be selling. That's going to be happening this summer. They did a 40-cent financing. There's stock coming out. They also have warrants coming out from both that financing and another one. The warrants are at 60 and 50 cents. There's about 21 million to 25 million shares of Siyata. They're going to be able to be sold, free trading, that could hit the market because they were purchased for less than the price. So I'm not saying be scared by this. I'm saying this is an opportunity for you. Don't create liquidity and an easy exit for people who want to sell. Sit on the bid where you think they might sell to you, higher than they paid but lower than the price. Put in a number of bids, layer your bids over a 5-cent range, and then wait for them to come and sell to you if they want. If they don't, then you can move your bids up.
All right, sound advice on Siyata Mobile. Let's move along to Photon Control. You've been around capital markets, as I mentioned, for a long time, and you do have the advantage, unlike some others, of getting some nuggets of information that others might not get. So, Photon Control we featured in last week's show. We had the CEO, Scott Edmonds. You want to talk about the previous CEO and a conversation that you had?
Yeah, I mean, because I have a wide following and I'm a financial journalist with, I've been doing it for a long time, I'll get CEOs calling me all the time to tell me their stories. And Photon went through a hard period where the founding CEO and the founders tried to appropriate their technology. They carved it out into another company, kind of secretly. Then they did an arrangement where Photon was paying this company royalties. Anyway, the board found out about it, fired them, or at least showed them the door. And then there was litigation. They brought in a guy to run it, Michael Goldberg, in the meantime, who is very capable as a turnaround specialist, and he did a very good job. I met him last year, liked the story, bought the stock. It doubled, sold it. He called me about 3 months ago, maybe 2 months ago, and he asked me for my help. He said, listen, I think I might be on the verge of getting fired. And I said, why? And he said, well, just the body language of the other board members, I'm getting shut out of meetings, and I'm not being included in things. And I guess he wanted me to rally support around him. And I just told him, I don't think I can help you because I don't know the full story. I don't have time to get into it. Plus, I didn't own any stock at the time. But I said, what do you think their end game is? And he said that some of the shareholders of Photon run a private equity firm. And he said that they own in that firm a company that would make a nice sort of combination with Photon. He was basically telling me he thinks they want to buy it on the cheap and get him out of the way because he was obstructing this attempt. I don't know to what extent he's telling the truth. Maybe he just wanted to keep his job. I don't know, but 2 weeks later, he was gone, and there's a new guy in place. You interviewed him. I think there's a good chance, based on this, that this company may be a target for a buyout. So I think that's just a little bit of information that adds a little bit of certainty to investors who own it.
And I asked Scott Edmonds, the current CEO, is it a logical situation whereby it's a kind of company that would get taken out? He said because he's so early to the game here with Photon, he'd be horrified because he wants to run the business. But we'll have to see what happens.
Well, he probably also has options, right? That when you get your options when you join as CEO. And so they're going to be priced at the price where it was. So he probably wants, to do as much as he can to grow the business, because it's a very good business. It's growing nicely, and that was one of the former CEO's issues too. He said he didn't want to leave a lot on the table if there is a buyout. So he's probably in the same position, which is good for shareholders.
Now, Fabrice, we've talked about 39-week highs, and we did a piece with you several weeks ago in the Capital Ideas Digest, and 52-week highs as well, and how often the trend shows and research shows that these stocks often go on to higher highs. So you want to focus on Dream Global REIT because that's what this one's doing.
Yeah, so the theory here is that, stocks that are, especially mature stocks they're not volatile. So commodity producers, it doesn't work as well with them. It doesn't work as well with smaller names. It doesn't work as well with things that are sensitive to economic shocks. But generally, if you're making a stable product or offering a stable service, and your company is doing well, your stock will start to hit 52-week highs, and it tends to keep doing that. So the idea, if you're an investor, an easy way to find ideas is to just watch companies that are starting to hit 52-week highs. And if you want to get a little riskier, look for 39-week highs. And I know you publish some of this in your newsletter sometimes. And then start to do your research. So I picked Dream Global as an example because it really has started hitting 52-week highs relatively recently. It has a 7.5% yield. They had some troubles. They're largely in Europe, so it's a bet on Europe. There was some skepticism about it because a lot of their properties were under Deutsche Post Office, German post office buildings, and everyone said, oh, the post office is not a thriving business, so you're going to lose your tenants. Well, they've managed to convince people that they have a plan for this, and so now the stock is starting to move. And I think if they can keep getting traction with a 7.5% yield, you look at average yields out there, they're more like quality yields, they're more like 6.5. So you probably have some upside here, so that 52-week trend might continue. Now, I have to add a caveat to this. If we get an interest rate shock, then it might be a different story because there are external factors on a REIT that could determine the outcome of the stock price. But as long as interest rates stay low, even if they climb a little bit, I think this one's interesting.
After the home capital debacle, a lot of companies got grouped in with them.
Sure.
And a lot of people were short and are short home capital. But it's interesting that in a sort of a contrarian way, you're wading into goeasy. So explain what the thinking was going into that.
Sure. So goeasy, as you appropriately pointed out, is sort of lumped in with the alternative lender group, and yet they really have nothing to do with mortgage lending. goeasy's business is more installment loans in that space that would service not payday loan, but not prime, so the sort of right in between. And we did a lot of diligence on the loan book itself, on their lending practices, and it just seemed to us like this was a perfect opportunity of people misunderstanding or maybe throwing the baby out with the bathwater, and selling off shares in what we view as a very well-run company.
So you've got the Easy Financial, which is the faster growing part of the business, and then the leasing side, which is sort of the legacy business. So how do they work together? In terms of, does the legacy side sort of buttress the Easy Financial in a way?
Yeah, a little bit. I mean, so Easy Financial has actually been working to set up physical locations around the country, and what they're actually doing is converting the old Easy Home locations into lending centers as well. So that's from just a physical presence perspective, it's very helpful.
So the leasing side. You've got the leasing side and then the faster growing financial side. So give us a sort of an overview of the two businesses.
Sure. So the leasing side is furniture leasing. Originally, what you would have thought of are like staging houses and things like that, and also just for consumers who are looking to lease furniture rather than own it. It's a shrinking business. Most people can finance any furniture many years out now, rather than actually just lease it. Whereas Easy Financial, again, is installment loans. It's more along the lines of, say, you want to build a deck or something like that, and the bank doesn't necessarily want to lend to you, and you don't want to go to loan sharks. Easy Home is serving that interesting niche that is very underserved in Canada.
So anywhere from $500 to $15,000 roughly. Yeah. Okay. So one thing I found interesting in this day and age of so much talk about financial technology, you can do so much on your phone. You don't need to go to a branch. Something like 90% of their applications are actually done physically in branch, the old school way. So,
Sure.
So why is that, and why is that an advantage?
Well, it's by design that happens. So any loans that are even originated online, they try to close them in person. And what Easy Financial has actually found is that you have a 30% lower loss rate on loans that are closed in person. I'm not sure, maybe it's a psychological thing more than anything. I can't necessarily explain it, but that is the number. I would suggest it probably has to do with the relationship that you develop with the loan officer in whatever the location is, rather than clicking a button online.
So at what rate does goeasy lend generally, and at what rate are they charging their customers?
So the average interest rate that that goeasy takes, we would call it in the mid-40s. So it's a big number.
Yeah,
yeah,
it's healthy.
Yeah, you know, it's healthy, and that's what yields a very healthy, what we would call net interest margin on Easy Financial. So they effectively lend at in the mid-40s, and their cost of funding is, call it between 7 and 8%. So that net between those two numbers yields, you know, a very, very healthy margin for the company.
And then, do you know what the figure is in terms of non-performing loans? It's quite low.
Yeah. So it's 13.9% to be specific in the last quarter anyway. And so the provision against that, they generally provision between 14 and 16%. So they've got a reasonable buffer there, just on the quarter-to-quarter basis. So 13.9 is what they charged off in the last quarter.
So, but very high compared to a big bank, obviously.
Yeah. Absolutely. So that is, of course, offset against the very high net interest margin of, call it 37% in Q1 versus maybe 2% for a bank. And the other very interesting thing to think about is the equity buffer that goeasy has. So on a total capitalization basis, maybe 40% of the capitalization is equity, whereas banks, you run roughly between 10 and 12% of CET1 capital anyway. So even if you did have a spike in non-performing loans, you have a very large buffer so that the company or the shareholders theoretically wouldn't have to start taking losses on those loans.
So most of goeasy's clients, people who can't get loans from the bank?
Yeah, so the way goeasy, and they're actually remarkably diligent in terms of the background checks that they do, but generally the way it works is they will, everything is income-based, whereas banks will generally go on your credit score and very little else. Maybe they'll look at your assets. But goeasy is, you know, their target credit score, or their average credit score, is between 500 and 650. And then the income verification process is very strict. So it's basically just on debt service is the way they would lend.
I saw in your notes that they don't have a lot of leverage comparatively. So how much debt do they have, and how does that relate to sort of a debt-to-income ratio?
Yeah, so the amount of debt, again, so the 40% equity versus 60% debt capitalization, that 60, I would caution against thinking about that as net debt, because that's their entire source of funding. Would be, for instance, they just did a convertible debenture issue at 5.5%. Again, you know, you're borrowing at 5.5%, you're lending at 45. So but the debt, it's the most well-capitalized financial I've ever seen.
Really?
Well, I don't see any other financials or lenders out there with 40% equity.
I said debt to income. We're talking debt to equity, essentially, right?
Yes.
Yeah. Okay. Right. So, would you say that that they're quite prudent in terms of who they accept, and that they actually do reject certain people? Yeah. Yeah.
So we went through the process a few times, just sort of seeing whether or not you know, we would be accepted for loans based on various lies that we told. No, they're quite prudent, and it certainly seems as though they're very good. Again, it's sort of like it's a high risk corner of the economy for sure, in that you have lower credit score people and you're lending based on income, but they're very, very diligent about the verification of that income.
Right. We've talked about goeasy and Capital Ideas research, and we've watched it. I don't own it, but I've watched it run up, and it seems like it's kind of got away from people if you didn't own it. So tell us about the investment case now in terms of the valuation after this pullback.
Sure. So we just started buying it maybe 2 weeks ago on the sell-off. I think it's an interesting sort of second chance on a name like this. We sort of felt the same way, that it had gotten away from us. And again, our fund is short bias, so it's maybe a bit different than what we typically would look at. But deep value is deep value, and trading at, I'd say 7 times next year's earning, you know, depending on how well they do, might even be less than that. And at a price to book multiple that is historically low for them, I would say it's as good a time as any to own the stock. It's a very interesting time.
Solar power has been around for a long time, but it's only recently that it's taken off because prices have come down so dramatically. This is where Solar Alliance comes in. This is a Canadian-listed company that operates primarily in California, but it's moving into other areas of the United States. It sells solar power roof panel systems in the residential and commercial sectors, and it has William Shatner backing it. What more do you want? Here's the CEO of Solar Alliance, Jason Back.
So we're a residential and commercial and industrial solar installation company. We sell solar systems and market to the customer, and then manage an ecosystem of installers that installs the technology on people's rooftops. Our model is different than others, as a lot of the big guys, we're a small microcap company, a lot of the big guys tend to be vertically integrated across a spectrum of the sales and installation process. So they have a sales team, they have an installation team, some of them create and manufacture their own technology. And we found that that type of model is heavy, it distracts from the core value of the installation process. So we're focused on the key parts, the highest value parts of the curve, which are the sales and marketing and ultimately the financing and ownership of these systems. We've been around now for 15 years in one form or another, developing renewable energy technologies. And we've seen the growth and consolidation in the wind energy space, and we expect and see the same thing happening in the solar space. Solar is at its infancy. The cost of solar has fallen by a factor of 4 over the last 5 years. The number of installations across America on residential rooftops is only 1%. In California, in certain areas, it's 5%. So the penetration is really small. The consumer doesn't really understand solar yet. They have to be educated, they have to be taught about the cost savings that come with solar. So it is at the early stage in infancy, and even though it's at its infancy, the cost keeps falling. So solar is getting cheaper and cheaper every quarter, not annually, but every quarter we're seeing drops in the material costs for solar, taking the cost down from about $8 or $9 a watt in 2008, all the way down to $2 a watt installed in 2017. Our margins have been the same throughout this spectrum, and we've been selling solar now since 2013 with the companies that we've acquired in the solar space, with over 10,000 customers and 10,000 systems that have been installed in the Southern California area. So we make our return by taking a margin at the point of sale. That's it. We take a margin, we sell a system, and we have very attractive gross margins of about 33 to 42% over the last couple of months. Those margins are continuing as the costs of components decrease, and because of how we sell solar and because of how we educate the consumer and because of how we save the consumer money, we can maintain those margins. So it's attractive as an ongoing business, and as the business evolves, we're evolving with the market. So not only are we planning to take just a margin at the point of sale, but we want to own these assets. These are attractive assets. In San Diego, a rooftop system, an average system size of about $25,000, 5 kilowatts, will have a very attractive unlevered return that we want to own, so that we can take the benefit of the ownership and the savings of power for the consumer and split the benefit with the consumer, so that they can have a solar system on their roof at no cost. And by combining different profit centers, your margin at the point of sale, recurring revenue from system ownership, and offering new products such as batteries, home storage batteries, which we've started to do in the last month, we can increase our return per customer as we grow into the space. The beginning of May was exciting in California, as there's a new state incentive that has just been introduced. Basically $5,000 per battery system is refunded to a resident in California. So assuming a cost of just over $10,000 for a home battery, there is something called the investment tax credit in America that writes off 30% of that cost against your taxes in year 1. There's a $5,000 incentive on top of that now, just launched at the beginning of May, that we are now in the process of obtaining for our customers, so that we can deliver batteries to the customers at a very low cost, of roughly $3,000 to $4,000 for a home installation of a 7 kilowatt hour battery. We're working with some of the major manufacturers of batteries in the market, and certainly we'll be telling our shareholders and customers more about that going forward. But we actually do have some battery sales now, and we're looking to expand our battery sales to every solar system that we sell. And that means more margin per customer, more product, a better system, better reliability, backup power, being able to shift your power generation from noon, when people may not be at home, to utilize in the evening. So storage is the next iteration of this market, and we're taking advantage of it with sales today. Last year we had about $5 million in revenue, nothing huge given the market and the potential. That was only on residential sales. We've now, over the last 2 months, we've acquired a very large sales team in the Los Angeles area from a solar company and have tripled the size of our sales team. Revenue is directly proportional to headcount. More salespeople incentivized appropriately means more revenue and more profit. So we are growing our team. We are able to sell not just to residential customers, which we were doing last year, but to commercial customers. And we're involved in looking at various additional acquisitions to grow inorganically with the acquisition of some distressed opportunities in the commercial and residential space. Very opportunistic, but also organically growing our team as well. Growing in San Diego, growing in Los Angeles, recruiting. Partnerships are very fundamental to growing our revenue this year as well. We've announced a relationship with ultimately Creus Energy Trust that owns Creus Solar in the Massachusetts market. So we now can very cost effectively expand into Massachusetts by using a Creus sales platform and installation platform, so that we're all focused on what we do really well and what we get a great return at, which is the sales and marketing of solar systems. So partnerships, acquisitions, organic growth are all projecting to add potentially 27 to 30 million in revenue to our targets. So we're definitely seeing some impressive growth.
The potential for knowledge and advancement is equally great.
We have a relationship that we developed with Mr. Shatner now for almost a year, where we approached him. He approached us via social media, and we started talking. We went up to his house, and ultimately he decided to buy a solar system from us. He joined our company in April, and what Mr. Shatner brings with his Priceline experience, with his focus to the consumer and his ability to move eyes and views to various products is a way to communicate differently with the consumer. So he's our spokesperson. Absolutely, we would love to get him on your show and have him talk about how he's going to be conveying information to homeowners in a way that they'll understand and respond to, which is something the whole industry is trying to figure out the best way to do most cost effectively, and ultimately to educate people in a very short time frame so that they can see the savings benefits of solar and understand that for, again, $0 down, you can save 30–40% on your utility bill with solar systems. So the economics are incredibly attractive for solar, and Mr. Shatner will help us with that. Size. People would say, why would you invest in Solar Alliance as opposed to Tesla, which acquired Solar City? It's size. It's the strength of our management team, the experience of our management team, all being focused in a micro-cap company that had stock already double and triple over the last few months. So because we're such a small company, when you start driving results, the market responds to that. And that means returns for shareholders. Returns from shareholders that are based on actual revenues and based on profit. So in our operating companies, we've now achieved profitability. And that's a turning point and an exciting point for a company. So we want to continue to grow that, be profitable, but also see the excitement around a small cap stock. We've been a small cap stock in this space. We've seen the benefits of doing that, and when you achieve success with a great team, great product, and fantastic spokesperson like Mr. Shatner, we're going to be able to drive the news flow and the excitement for the market to respond to what we deliver.
We've got some insider activity for you now. This is where we look at officers and directors and the various insider buying and selling that they've been doing in the shares of the companies that they're involved with. We'll start with Amaya Gaming. Tang Hao recently bought 1.1 million shares in the company, worth $27 million. This gives him 12.5% of the shares, or $440 million total. What's interesting is that Tang Hao's buying has coincided with the selling of David Bazoff, the former CEO of Amaya, who was charged with insider trading. Moving along to Morguard REIT, where the CEO, Kuldeep Sahi, recently bought nearly 400,000 shares in the company, worth $6 million. He has recently increased his stake by 58% to a total of $15.6 million. Conversely, we're taking a look at Radiant Technologies, the COO, Michael Gabagon, selling more than 400,000 shares. In fact, he has sold 75% of his position recently. The recent sale at 50 cents a share. He now owns 135,000 shares in Radiant. We have some 52-week highs and lows for you now, starting with Hydrogenics. Look at this stock hitting multiple 52-week highs before really taking off recently. Now, some technical analysts might suggest that the stock needs to come back to test these levels, although that doesn't necessarily have to happen. Bottom line, the stock really breaking out lately. Conversely, we want to look at Prem Watts' company, Fairfax Financial. This one, back in the fall of 2016, at much higher levels. Look at it now, breaking through the 580 level and hitting multiple 52-week lows. Another 52-week low worth talking about is this company, Meg Energy. We know that energy shares continue to be under pressure with the glut of oil. Meg Energy recently hitting a number of 52-week lows. From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Thanks a lot for joining us, and thanks for investing like a pro. We'll see you next time.